If you're looking to buy Palantir stock, then please keep watching this video because we're going to look at the company's recent news, how's the market treating the company, and what are the technicals telling us, and most importantly, what is the best trading approach. As the market is still very volatile at the moment, we should be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Palantir has been having a lot of volatilities over the past few months, from historic highs to massive sell-offs, and at the current stage, we're left wondering, is this the end of the sell-off phase? Can we hope that the stock will start going to new highs once again as the recession is getting priced in and that investors are reconsidering to have exposure in tech stocks in general? This is obviously a multi-layered issue, and the final outcome will depend on the personal situation for each and every person participating in the market. First and foremost, given the current price action, are we out of the sell-off phase yet? That's what most people who have been buying Palantir over the past few days were hoping, and I do believe that they're growing in numbers as well. So far, Palantir has been able to maintain its price above $10 per share, which is a very important psychological level for market stakeholders, as well as an important level to compare the overall stock performance from the day it first began trading in the market to today. Now, if it can maintain that level over the upcoming weeks and months, I do believe that Palantir would be able to keep the upward momentum for the next couple of weeks and months. Now, let's take a look at the technicals of Palantir. The trading volume has recently been around 24 million shares versus an average volume of 30 million shares. Over the previous 52-week period, the price fluctuated between $6.44 and $29.29. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market and if there is enough liquidity to support a trading strategy. If the float is very thin, it would be very easy to influence the stock price, but with the low liquidity, it could also mean that the demand is very limited as well. When we compare the current volume against the average volume, there might be the possibility to see a trend reversal or the breakthrough if the difference is very large. For example, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Palantir is currently around $21 billion against the enterprise value of $26 billion. Simply put, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company's already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be the intangibles, meaning they are not items or stocks that companies can use right now, but pledges for a brighter future, such as new product schematics, IP, and brands. For startups, most of their valuations are based on the intangibles, and if they were valued in more favorable market conditions, what this could mean is that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that a company is trading at a discount. It's only trading below its book value, but it doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place and that it has deflated itself ever since. As we compare the current price to historical price fluctuations, the stock is 21% higher than the 1-month low, 63% higher than the 3-month low, and 63% higher than the 52-week low. On the options market, which often gives us a hint about the market sentiment, the implied volatility is 75% versus the historical volatility of 67%. The put-call volume ratio is currently around 0.37. It is normal for most stocks to also have a higher put option volume than what they deserve, as many institutional investors hedge their long positions with options. The most recent volume of options traded is 55,000 contracts a day versus the 30-day average of 114,000 contracts. In terms of open interest, the most recent volume of open interest has been 2.4 million contracts versus the 30-day average of 2.5 million contracts. The option contracts are tools, allowing traders to hedge their risks and increase their exposure, as well as having an extra revenue stream. They are derivative contracts based on the underlying security. They give traders the possibility to buy or sell the security at a predetermined strike price and helps limiting the potential downside. The put options allow selling at a strike price, usually chosen for anticipated downturns, and the call options allow buying at the strike price, usually for bullish runs. Regarding the shareholder structure, institutional shareholders currently own 31% of the outstanding shares. The biggest shareholders include Vanguard, Citadel, and Susquehanna International. Usually, it is best to see some institutional participation when holding a stock for the long term because it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it'll deliver value in the long term, which is an important factor to consider for investors. Personally, I consider the minimum threshold to be around 25 to 30% of institutional participation. There could be many exceptions to that rule, as there are always great companies mostly owned by retail traders somewhere as well. Now, let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. There could be significant short interest in the total volume if there's an organized short operation going on, such as what happened with GameStop and AMC. Let's also take a look at the short interest of the stock, which is the number of positions that'll profit from falling stock price. The way it works is that short positions will borrow the shares from brokers, sell them in the market now, and buy them back later, profiting from the difference between the two timings. If there is significant short interest, usually above 25 to 30%, there could be potential for a short squeeze, whereby traders will buy the stock up, forcing those with short positions to close them to avoid further losses, acting as a buy in the stock market's action. This is what people refer to as a short squeeze, and it became a popular concept in recent times, with stocks like GameStop and AMC been short squeezed successfully. The current short interest is around 6.2% of the total float, with 52% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant chunk of it out of the dark pools, this suggests that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. I would recommend to buy Palantir now, and to save a portion of the allocation to be used once the stock goes beyond $12 or $13. If it doesn't occur, then I would recommend to use this part of the allocation to gradually buy in the shares over the next 24 months. I would recommend to commit between 5 to 8% of your portfolio in Palantir. I would also recommend to split your allocation in batches of 20 to 30% at a time so that you may purchase more in case it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.